Hi everyone, we're going over chapter 7 this week in the online session, and I wanted to go over the capital market history in terms of various asset prices. And what we're going over in this chapter is chapter 7, talking about risk and return. Now, when we talk about risk and return, we're always going to refer back to US stocks, bonds, and treasuries. And we're going to compare the returns on these three various asset classes to see essentially what was the return, what was the risk historically between these three. So as we look down here in this chart, a dollar invested at the end of 1899 would have grown by the end of 2017, assuming reinvestment of all dividend interest payments. So basically this is showing us the growth of $1 over about 117 years. Okay, so we see the bills, the treasury bills, the bonds, the corporate bonds, and the equity is over here. Okay, so just to get a feel for this, and this is the real terms outside of inflation. So big difference outside of inflation as well. Very interesting in real terms of what's going on. Okay. And these are the risks and returns. So what do we mean when we talk about the average annual rate of return? Is basically we're talking about actual returns averaged out over the entire period. When we say nominal, that's basically the actual return. For treasury bills was 3.8, for government bonds was 5.3, and for common stocks was 11.5. The real means just minus inflation. And the average risk premium, this simply means what was it over the return on treasury bills, because assuming treasury bills are 100% safe, what am I getting in addition to what's absolutely safe? So with bonds, it's 1.5, with common stocks it's 7.7. And this essentially sets us up for this chapter talking about the average annual returns, how do we compute the risk, and basically looking at historical evidence to evaluate today's cost of capital. This, by the way, from what we did in the previous session regarding valuation of equities, and where we actually use the risk rate, this is what we're talking about here. We're talking about that risk rate which we use to discount the earnings. And that risk rate, I believe we use 10 to 15%. Here they're showing us that actually that risk rate is set, the risk premium is 7.9%, 7.7%, and the actual total market risk is the risk premium plus the risk-free rate, which right now, as they're saying, or when this was written earlier this year, was 2%, and so that gives us a risk rate of 9.7, which is actually the S&P 500 is what we're talking about, and that is close to 10%, which I believe we used for some of the companies. So this is the rate, and that is essentially if something is in the S&P 500. Common stock we can use as the risk rate, and we're gonna look in the next video. We're gonna look at an exercise of looking at these returns in Excel so that you could see how to calculate the average returns and also how to calculate the standard deviation. So that's something that we're going to continue looking at the returns. But before that, just looking at the average market risk premium. So this is nominal return of stocks minus nominal return of bills, average in various countries. So we could see the US is actually right here at 7.7, below France, South Africa, Japan, Finland, Italy, Germany, and Portugal. And this is, I also thought this was very interesting. The chart regarding dividend yields in the United States have been going down, and what this explains is saying that using the formula we've been using for valuation, present value of stocks, but saying that essentially what happened was instead of dividends companies have increasingly preferred to distribute cash by stock repurchase, and that is essentially what we've seen either. And you could even see that dividend yield drop dramatically because of this new phenomenon that is relatively new, and they're showing you how that actually impacts the formula, the annuity growth formula, and we're going to look a little bit more into that later on in the chapter as well.